Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another crucial session. Today, we are cracking open one of the most polarizing, debated, and, well, frankly, fascinating companies in the modern market landscape, Tesla.
It really is. I don't think any other name comes up more.
And look, we aren't here to look at incremental quarterly delivery numbers.
No, that misses the point entirely.
We're here to analyze Tesla through the lens it demands as an AI and robotics company that just happens to manufacture vehicles.
Right.
The central question we have to unpack today is just critical for every investor's portfolio. Is the massive, almost unbelievable valuation premium this company commands defensible? Is it based on its exponential optionality, or what we're calling the Lollapalooza thesis, or is it just permanently vulnerable?
Vulnerable to an eventual painful reversion back to the multiple of a mundane cyclical automaker.
Exactly. We need to determine if this exponential bet is a brilliant strategy or, a house of cards.
That is the fundamental question. It is, I think, the only question that matters when you're discussing this stock.
Really? The only one?
I think so, because if you strip away that optionality, the numbers, they just do not compute against traditional auto peers. The premium demands a future that is completely fundamentally different from the present.
That's a massive question.
It is. And before we get into the details of how their strategic choices create, or maybe fail to create, that optionality, just a quick note for everyone listening.
Oh, right. For those of you who want to act on these investment ideas, having a professional-grade platform that can handle complex trading and, global markets is key. We use Interactive Brokers.
We do.
And we've partnered with them to get our listeners a stock bonus when they sign up through our dedicated link.
So you get a bonus to start or expand your portfolio, you get access to world-class trading tools, and you support this independent deep dive format at the same time.
So win-win.
That link is, as always, available right there in the description for you.
That's right. And, of course, if you find value in this kind of in-depth discussion, the best way to let us know and to make sure you get future analyses is to just hit that subscribe button and give us a like.
It truly helps us bring this level of detail to you every week.
It really does.
Perfect. Now let's get straight into the engine room. We have to start by defining the core business and really understanding the competitive fortress they've built.
Yes. Before we can even assess the exponential optionality that's built on top of it.
Exactly. The foundation.
Okay, let's unpack this. We'll call this the foundation. The business model and the moat. On the surface, the revenue generation seems straightforward, right? It seems pretty simple.
It does. They sell cars.
They sell high-volume electric vehicles, the Model 3 and Y, and the higher-margin S and X. And then they have the energy products, things like Powerwall storage solutions and solar roofs.
Right, that hardware cash engine is the primary revenue stream for now.
But focusing purely on the sales volume is a trap. If you look closely, you realize the true profit drivers aren't just unit sales.
Not at all. It's actually deeply leveraged operational efficiencies and, of course, software.
So how does that break down?
Well, profit is driven by two massive levers. First, just achieving manufacturing scale at the gigafactories. That relentlessly drives down the per unit cost of both the vehicles and the battery packs. They are optimizing complexity out of the system.
Okay, scale. What's the second lever?
The second is the high margin recurring software and services revenue, which is dominated by the full self-driving or FSD software.
That $10,000 add-on.
Right. Sold either as a high cost upfront purchase or increasingly via subscription. That's almost pure profit.
That structural framework, then, that provides the business with some undeniable endurance, doesn't it?
It has to.
The core product, electric transportation, it's a necessity, given the global structural shift from internal combustion engines to EVs, regulation, necessity, consumer preference. It's all pushing this forward.
That's a durable bedrock to build on, no doubt.
But what about their specific products?
Well, the endurance of their specific product line comes from the architecture itself. It's a simple, robust, physical product, the EV and the battery integrated with this highly sophisticated, standardized, software-defined vehicle platform.
And that integration is the key.
That integration is what makes the overall technology platform exponentially more difficult for rivals to replicate than, just building a competitive car body.
Right, and this immediately leads us to the economic moat, the competitive fortress. It's not a single wall, is it? We're talking about the dual moat here.
Absolutely. Two massive competitive advantages working in synergy.
So what are they?
We define the primary competitive advantage as a combination of cost advantage and the data AI flywheel, which is this massive intangible asset.
Okay, let's start with the cost advantage, because this is where the operational genius really meets the engineering.
It is, and the financial evidence for this is, frankly, irrefutable. They have repeatedly shown the ability to lower the sticker prices of the core Model 3 and Y vehicles.
While keeping their margins high.
Exactly. While simultaneously retaining a gross margin, the profit margin after manufacturing costs, that is superior to the margins of almost every legacy automaker's dedicated EV division.
Which means they can sustain a price war that would, it would bankrupt many competitors.
Absolutely would.
That level of operational execution is what separates a good company from a world-class one. But how do they actually pull that off? What are the specific technical details that give them that edge?
It's two things: intense vertical integration and manufacturing innovation. They control the battery supply chain, their entire software stack, so no reliance on third-party APIs for core functions. And they pioneered these innovative techniques like Giga-Casting.
Giga-Casting, let's dig into that because it's crucial.
It really is. Instead of welding or stamping hundreds of individual parts to form a complex underbody structure, they use a massive machine, a literal gigapress.
I've seen pictures of these things. They're the size of a small house.
They are enormous, and they use them to cast large sections of the car, like the entire rear floor, as a single piece of aluminum.
So hundreds of parts become one.
One. This drastically reduces part count, assembly time, capital expenditure, factory footprint, and most importantly, the overall unit cost. They save thousands of dollars per car just through this process alone.
Which simplifies the physical product immensely. It effectively starves their manufacturing rivals of a profit margin. Okay, but let's turn to the part that really justifies the sky-high valuation. The AI data moat.
This is where the exponential opportunity lives. The AI data moat is rooted in the continuous, proprietary, real-world driving data collected from their fleet.
Billions of vehicles globally.
Exactly. Acting as rolling data collectors, constantly feeding information back to the central neural network.
This creates what you call the closed-loop feedback system, right?
Precisely. More vehicles on the road means vastly more diverse data, especially regarding complex or rare edge cases, those unexpected events that trip up autonomous systems.
Like a deer jumping out at dusk, or a weirdly shaped traffic cone.
Exactly. And more data means a rapidly improving training environment for FSD. Better FSD, theoretically, accelerates adoption because the product is superior, which in turn puts more vehicles on the road. And the loop continues.
I see the flywheel, but let's talk mechanics. Why is their data proprietary superiority so hard to replicate? Why can't GM or Waymo just buy enough data?
Because it's about the depth and the control over the entire stack. Tesla controls the vertical, the camera hardware, the custom-designed AI training chips.
Like their Dojo supercomputer.
Right, Dojo, and the neural network architecture itself. This allows them to label, categorize, and use data points with incredible precision.
And their competitors.
Competitors using LiDAR or pre-mapped high-definition routes are, in a way, solving a different and maybe easier problem. Tesla is trying to solve generalized autonomy using pure vision, just like a human driver.
And that requires a different kind of data.
It requires a massive sustained influx of diverse proprietary vision data that frankly just doesn't exist anywhere else.
So the moat is actively widening. While rivals like BYD are catching up on battery efficiency, Tesla is shifting the focus from being a high-volume car manufacturer
toward a capital-efficient, AI-driven mobility and robotics company. Think CyberCab and Optimus. The car is becoming the data harvesting tool.
They are leveraging the existing data moat for exponential value creation.
Not just for incremental sales growth.
Yes.
Exactly.
This brings us perfectly to the mental model that really defines the whole investment thesis, the Lollapalooza effect.
A Charlie Munger classic.
He defined this as a powerful, nonlinear outcome achieved when multiple reinforcing factors converge all at the same time. It's not just 1 + 1 + 1 equals 3.
Oh, no. It's 1, 1, 1, where the output becomes exponential.
So for Tesla, what are those factors? We see 3 reinforcing factors. First, the vertical integration and cost advantage in manufacturing, the ability to build cheaply.
Okay, that's
Second, the powerful brand and intangible asset. And third, the data AI flywheel, the ability to automate the product itself.
And here is the crucial insight. These factors actively reinforce each other. It's not just that they exist side by side.
What do you mean?
For example, the cost advantage. the ability to repeatedly cut prices, that drives higher unit volume. Higher unit volume feeds the data AI flywheel, which makes FSD better.
Okay, I see that connection.
And crucially, if FSD becomes truly functional, it dramatically lowers the total cost of ownership for the consumer, which then further reinforces the original cost advantage.
Wait, how does FSD lower the cost of ownership? That software costs $10,000.
Because the largest cost of ownership for any vehicle over its lifetime, especially a commercial one, is the driver and the insurance.
Oh, right.
If FSD can demonstrably reduce accident rates below human levels, it radically lowers the company's insurance costs, making the vehicles cheaper to operate.
And then there's the Robo-Taxi idea.
Furthermore, if the car can operate autonomously as a Robo-Taxi, it generates income for the owner, turning the vehicle from a depreciating asset into a revenue generator. That synergy cost plus data plus brand, that is the Lollapalooza.
That's the exponential outcome.
This exponential synergy is what convinces the market to pay the enormous premium. They aren't valuing the current sales of the Model Y. They're valuing the fully realized Robo-Taxi network and Optimus, which arise when those three moats reinforce each other in a nonlinear fashion.
Okay, so that's the theory. But before we move on, we have to touch on the internal and external reality of the company, what we call the cultural double-edged sword.
It is a massive paradox. It really is.
Yeah.
On the customer side, the loyalty is often described as, cult-like. Longtime owners are mission-driven and dedicated to the technology.
They put up with a lot.
They tolerate a lot, including the pricing volatility. But we frequently see reports and sentiment analysis flagging criticism.
Oh, yeah. Inconsistent build quality.
Uneven or often poor service center experiences, and significant frustration over aggressive pricing volatility.
I have a friend who bought a Model 3 in Q1, only to see the price drop by 15% in Q2. They love the car, but they felt like fundamentally betrayed by the company's pricing strategy.
And that's a real risk to brand goodwill.
Absolutely.
And we are seeing evidence that the novelty is cooling, especially in sophisticated markets like Europe. Recent sales dips suggest that competitors have finally caught up enough in terms of basic quality and features that the technology factor alone isn't overcoming the quality and service hurdles anymore.
Exactly.
Now let's look inside. On the employee front, they attract genuinely top-tier engineering talent driven by solving world-changing problems. The culture is high pay, fast-paced, and highly mission-focused.
That is how they innovate, there's no question. But that same high-pressure, no-tolerance for incompetence culture, often driven by a very top-down management style, leads to intense pressure, burnout, long hours, and high turnover in non-engineering departments.
So while this drives rapid, aggressive innovation, they move faster than anyone else, it inherently limits their ability to achieve stable, multi-decade operational excellence.
In areas like customer service and consistent manufacturing quality, yes, it's a culture designed for sprints, not necessarily for marathons. That is a critical risk. Let's quickly put this dual moat in context by looking at the competitive landscape. Who are the primary rivals and where are they hitting the hardest?
We see two distinct threats. First, the cost leader, BYD, primarily based in China.
A powerhouse.
Their core strategy is undeniable cost leadership and extreme vertical integration. I mean, they control everything, from the battery raw materials right through to their own semiconductors. They are an operational powerhouse.
And their differentiation is massive affordability and breadth. They offer not just battery electric vehicles, BEVs, but also highly competitive plug-in hybrids, or PHEVs.
Which appeals to a much broader, more cost-conscious and infrastructure-constrained global market segment. They are attacking the core hardware market relentlessly.
So what's Tesla's defense against BYD?
It remains the AI FSD stack, the software differentiation, and historically, the supercharger network.
But that's changing, isn't it?
It is. The wider industry adoption of the North American Charging Standard, NACS, is slowly eroding the exclusivity and thus the power of that infrastructure advantage.
Okay, so threat number one is BYD on cost. What's the second rivalry?
It's with the legacy auto giants Volkswagen, GM, and Ford. They leverage massive existing global scale, deep entrenched dealer networks, and decades of manufacturing experience.
They aren't fast, but they are giants.
And Tesla's durable advantage here is twofold. First, The sheer pace of their innovation and their low-cost manufacturing platform we just talked about, Giga-Casting,
And the same.
and critically, the efficiency gains from their direct-to-consumer sales model that completely bypasses the massive frictional cost of the dealer network. Legacy auto companies are struggling to replicate Tesla's pricing structure because they have to accommodate those dealer margins.
Right, they're stuck with that model.
Yeah.
So to summarize the foundation, the core business is durable because of the shift to EVs. The competitive advantage is a powerful, self-reinforcing dual moat of cost and data,
But that foundation is facing intense pressure.
which means the premium must rest entirely on the exponential optionality.
Which leads us directly to Pillar 2, management stewardship and the financial fortress.
Absolutely. The unique decision-making at the very top defines the risk profile of this company in a way we rarely see.
Especially outside of founder-led companies.
The CEO's philosophy is defined by really two principles. First principles thinking.
Which means breaking down every assumption to its most fundamental truth and rebuilding it from scratch.
And second, a quasi-religious focus on a long-term, mission-accelerating sustainable energy and now general AI. He operates with an aggressive, maximal innovation at all costs mindset.
And this mindset creates a management philosophy that prioritizes maximal growth and aggressive, risky reinvestment into future exponential growth drivers.
FSD Optimus.
Right. For short-term, predictable, quarterly profitability, they are constantly willing to sacrifice near-term margins for long-term dominance.
And the incentive alignment is just intense. Musk's substantial individual ownership, it's around 13% of the company or more, ensures a true owner's perspective.
And it's not just the ownership. His past compensation packages were structured not around incremental performance, but around achieving absolutely audacious market capitalization and operational milestones.
So he only gets paid if the stock goes up, like 10x.
Essentially. This structure explicitly incentivizes massive, nonlinear, long-term value creation. It forces the management team to think Lollapalooza because only those exponential outcomes, a massive leap in market cap, trigger the largest rewards.
No other CEO in the world has compensation so strictly tied to such high-stakes, long-term operational success.
It's completely unique.
And if you look at the capital allocation track record, it just confirms this philosophy. The primary focus is massive, aggressive reinvestment into scaling capacity-building gigafactories in Shanghai, Berlin, Texas.
And heavy R&D, especially in AI and robotics infrastructure like the Dojo supercomputer. M&A activity is minimal because they believe they can build almost everything better internally.
This brings us to what you call the rationality test.
Right. When we see the company deploying billions of dollars into proprietary AI chips and the concept of humanoid robots like Optimus, we have to challenge the logic. Is this rational capital allocation?
To an investor who sees them as just a cyclical automaker, deploying billions into Optimus seems wildly irrational, maybe even dangerous, a distraction from the core business.
It does. But it is only rationally defensible under one specific crucial assumption.
Which is?
That the future business, FSD, Robo-Taxi, Optimus, is orders of magnitude, perhaps 10x or even 100x, more valuable than the current business, which is just selling EVs.
So it's a bet on a discontinuous future.
A very high conviction bet. If they succeed in solving general purpose autonomy with Optimus, the financial return on that capital expenditure is almost infinite. It's a binary bet. Either they create the most valuable company in the world, or they deploy vast sums of capital for minimal return if their autonomy advantage proves illusory.
And this high-risk strategy is only possible because of the financial fortress they've established. While profitability was inconsistent early on, since about 2020, they have maintained impressive consistency.
But that consistency is being tested right now. We saw pressure on net income in recent years due to those aggressive price cuts used to combat competition.
Particularly from BYD.
Exactly. This illustrates the competitive reality. Even the most efficient manufacturer struggles to maintain high profitability margins indefinitely in a capital-intensive industry like auto manufacturing.
However, the quality ratios are what truly define this as a financially wonderful company, regardless of that temporary margin pressure. Let's talk about return on invested capital, or ROIC.
High ROIC, consistently achieved in profitable years, is the definitive proof that the cost advantage moat is real. It's not just a story.
What does it confirm?
It confirms that the massive capital expenditures, all those billions spent on specialized equipment and gigafactories, are generating returns significantly higher than their cost of capital.
Which, in an industry like auto manufacturing, is unusual.
It's extraordinary. An ROIC that remains persistently above 15%, and they often exceed that, is extraordinarily high. It means they are extracting maximum economic value from every dollar they plow back into the business.
Proving they have a tangible advantage over competitors who require more capital to generate the same level of profit.
Precisely.
And their free cash flow, or FCF, conversion,
Yeah.
is also remarkably strong, which again is rare for an industrial manufacturer.
It's a direct consequence of their unique model. They convert a very high percentage of their net income into FCF.
How?
The direct sales model eliminates dealer float. They get paid instantly, not waiting for dealers to finance or sell inventory. And critically, they benefit from substantial upfront customary payments for FSD.
Right, they book it as deferred revenue but get the cash immediately.
They receive it as immediate operating cash flow. So their balance sheet gets cash today for a software product they might deliver 5 years from now.
That gives them unparalleled cash flow to fund R&D.
Exactly. A recent look at their financials showed billions in operating cash flow converting exceptionally well into FCF. This FCF is the lifeblood that funds those expensive, high-risk AI and robotics pivots.
Finally, the balance sheet itself. This is the ultimate safety net that allows management to make these generational bets.
It is a fortress, plain and simple. They maintain a massive cash buffer, often in the tens of billions of dollars, and carry manageable net debt levels.
And that resilience is non-negotiable for their strategy.
It has to be. Without that stability, making aggressive bets on Optimus and Robo-Taxi would be reckless. With it, they are simply utilizing their superior financial capacity to pursue exponential value.
That sets the stage perfectly for our third pillar, valuation, risks, and catalysts. We need to dissect the premium.
The valuation profile is, by any traditional standard, extreme. It just is. It trades at this immense premium because the market actively views it and prices it as a growth technology company, not a cyclical manufacturing firm.
Let's be very precise about what the market is pricing in then. It's not the current profits from the Model Y.
Not at all. The current valuation is a discounted valuation of future, highly profitable AI, software, and mobility services cash flows, the complete realization of that Lollapalooza effect.
So the market is betting that FSD is solved, that Robo-Taxis scale, and that Optimus finds a commercial market.
It is a bet on foundational technological paradigm shifts that rewrite the rules of both transportation and labor. If you buy the stock today, you are essentially buying the net present value of a fully realized Robo-Taxi network in 2030.
Which may or may not materialize as planned.
Exactly.
And this brings us to the final critical hurdle for any investor. The price paid determines the return.
Always.
If you pay today for the assumption of a fully realized FSD Robo-Taxi future that generates maximum cash flow, and that future is delayed by, say, 7 years, or only partially realized.
Due to unforeseen regulatory hurdles or technical challenges.
Even if the underlying EV business remains successful, your investment returns will likely be poor because the growth premium was paid for far too early.
That's why we dismiss traditional PE ratios here. For this company, the margin of safety is defined differently. It's price to future value, PFV.
Explain that.
Safety is found not in historical earnings, but when the market indiscriminately sells off growth stocks or during a temporary company-specific setback, a production delay, a minor safety scare, a CEO controversy that causes a temporary panic.
Those are the moments when the optionality is temporarily discounted by an emotionally driven market.
Right. The true safety lies in the enduring net present value of that AI data moat. If you believe that moat is real, those temporary dips are opportunities.
So if Lollapalooza optionality is the thesis, what is the primary growth engine and what are the near-term catalysts we should be watching?
The key driver, the ultimate payoff, is the successful launch and scaling of the autonomous Robo-Taxi service, known internally as CyberCab.
This is the core exponential thesis.
It is. If FSD achieves technical and regulatory level 4 or 5 autonomy, it eliminates the single biggest operational cost in transportation, the human driver, and maximizes the utilization and profitability of every vehicle in the fleet.
So instead of sitting idled 90% of the day, a vehicle becomes a highly efficient 247 revenue generator.
Which unlocks exponential earnings growth.
Then what are the catalysts? The proof points.
We have two immediate, concrete proof points catalysts that would radically change the narrative and de-risk the optionality. The first is regulatory.
A government approval somewhere.
A major, clear regulatory breakthrough in a key market, whether the US or China, that explicitly permits genuinely driverless, non-supervised ride-hailing services. That validates the billions invested into FSD.
And that doesn't just mean testing. That means commercial revenue-generating deployment.
Exactly. The second, and perhaps the more expansively powerful catalyst, is the successful commercial deployment of the Optimus humanoid robot.
Yeah.
If they can move Optimus past the laboratory stage and implement it successfully in their own manufacturing or logistics operations, and then successfully commercialize it for third parties.
That would validate that their AI stack's leverage extends far beyond just vehicles. It proves they are a general-purpose AI company, not just a car software company.
And that opens up a new multi-trillion-dollar market for automated labor. It moves them from solving mobility to potentially solving the global labor shortage. These are the two high-stakes bets that the stock price demands success on.
Okay, now we have to address the opposite side, the permanent impairment risks. These are the existential threats that would not just hurt the stock, but collapse the premium valuation entirely.
The biggest one, the risk that permanently impairs the thesis, is FSD failure.
It doesn't work.
If they permanently fail, either technically or due to insurmountable regulatory roadblocks, to achieve level 4 or 5 autonomy that is superior or even equivalent to rivals like Waymo or others, the valuation premium evaporates instantly.
And the stock reverts to an automaker multiple. The years of extreme growth pricing become a value trap.
In that scenario, the market realizes that all that proprietary data was actually less valuable than the specialized hardware or generalized AI systems developed by rivals. The data moat, in effect, springs a leak.
The second risk has to be Keyman risk.
It's the unavoidable Keyman risk. The loss of the CEO, who is the central driver of innovation, strategy, and the defining cultural ethos, would be an immediate and potentially permanent shock.
The highly centralized nature of strategic ambition means no standard CEO succession plan could immediately fill that void.
Especially in the realms of long-term, high-risk R&D bets.
And finally, the hardware commoditization threat. Sustained, relentless competition, particularly from low-cost Asian manufacturers like BYD.
Could permanently erode the hardware margins of the Model 3 and Y. If the profit margins from vehicle sales are starved, if the gross margin drops from high teens down to single digits, that directly attacks the financial fortress.
It starves the R&D budget.
It starves the aggressive AI and robotics R&D budget that is necessary to achieve the Lollapalooza outcomes. It becomes a vicious negative feedback loop where competition undermines the ability to fund future defense.
So, we've covered the business, the financials, and the risks. Let's move to our final synthesis and engage in some second-level thinking. We have to look past the obvious narratives and challenge the core assumptions.
Okay. The prevailing market consensus is loud and clear. Many view the company as an overvalued cyclical car company whose premium is based on unsustainable hype, led by a charismatic but volatile CEO.
And the media focus is often on the slowing growth rate of EV adoption and the intensifying competitive pressure. That's the common story.
It is. But the contrarian position, the one required to justify the valuation, is that the market is fundamentally undervaluing the duration and the optionality of the core AI data moat.
So the company is already a leading AI and robotics entity that simply uses car manufacturing as its primary funding mechanism and data collection vehicle.
Right. The current price, therefore, is not a valuation on current EV earnings, but an aggressive discounted valuation on CyberCab and Optimus optionality.
It is a high-stakes, asymmetric bet.
A bet that Tesla will become the foundational AI and data provider, the picks and shovels, for the future of both mobility and industrial labor globally.
Let's run the red team challenge now. We need to invert the core bull case and scrutinize the claim of proprietary advantage. What is the most compelling argument for why today's investor might be making a major long-term mistake?
The red team argues that the AI moat is an illusion of proprietary advantage, and that the visionary CEO is a liability that creates unnecessary strategic risk.
This strikes directly at the heart of the Lollapalooza thesis.
It does. The entire bull case relies on the belief that Tesla's proprietary vision data is superior, and that they alone will successfully solve generalized autonomy.
But what if that's wrong? What if autonomy is eventually solved not by proprietary vehicle data, but by a generalized AI model developed by a competitor, say Alphabet Waymo?
Using superior large language models in simulation, or by a major chip and software provider, perhaps in NVIDIA for autonomy.
That is the ultimate commoditization threat applied to the software itself.
It is. If autonomy becomes a commoditized API or a single standardized chip that any automaker can license and plug into their own vehicles, a plug-and-play solution, then Tesla's proprietary data advantage instantly vanishes.
And the thousands of edge cases they collected become worthless.
They'd become worthless if a generalized system solves the problem more elegantly and broadly.
And what is the consequence of that inversion for the current investor?
The company is left as a highly efficient but ultimately cyclical and volatile car manufacturer with a unique but high-pressure culture. The stock, however, is still valued for exponential growth that will never arrive.
And all that capital they deployed into their own custom chips.
The billions deployed into developing Dojo, the FSD computer, the vision stack, all of it will have been an enormous sunk cost, wasted on solving a problem that could have been outsourced cheaper and better once the generalized solution emerged.
So the ultimate outcome, in that specific scenario, is that the company may still succeed as a business.
But it will deliver decades of zero or negative real returns for today's investor because the premium paid for the Lollapalooza was fundamentally misplaced.
That is the true existential risk of buying the optionality at today's price.
It forces a hard evaluation. Are you betting on proprietary vertical integration remaining king? Or are you betting on horizontal commoditization and generalized AI prevailing?
That brings us to the close of our deep dive. We have analyzed every angle of the Tesla investment thesis, from its operational moat to its existential risks.
And the core tension remains clear. Are you buying the world's most aggressive AI company that happens to have a car division, or are you buying the most efficient but ultimately cyclical car company?
The price you pay today demands absolute belief in the former.
It really does.
And it forces us to ask one final provocative thought for you to consider. Should investors completely stop viewing this company based on quarterly vehicle delivery numbers entirely?
And instead,
focus purely on its output of algorithms, proprietary hardware, and data models?
if the stock is indeed pricing in the exponential outcome, the only metrics that truly matter are the milestones toward achieving level 45 autonomy and Optimus commercialization.
That distinction between the car company and the foundational AI data provider is the ultimate determinant of whether the price paid today captures the required long-term value creation.
A lot to think about there.
We encourage you to explore the concepts of the Lollapalooza effect and the commoditization risk in depth as you analyze this thesis. And thank you for joining us for the deep dive.
And we'll catch you on the next one.
Safe investing, everyone.